Okay, now that we have posted all of these adjusting entries into our general ledger, we're now ready to prepare the final set of financial statements for this company. We'll not take the time right now to do it, but we could. We would just take the balances from each of the balance sheet accounts and the balances for each of the sales, cost, and expense accounts, and we'd create the income statement and the balance sheet from them, okay? That's what we would hand the tax accountant to prepare the tax return. That's what we would look at in future years to see how we did compared to subsequent years. And so it's very important that we keep that information available to us. And that's the 13th set of financial statements, right? Already did the 12, now we're doing a 13th. Once we have completed that entry, we are now ready for the final closing entry for this business. And that's listed in your general journal as entry G. And its purpose is to turn the score back to 0. Remember that at the end of every basketball game or football game or soccer game, we look at the score, we say that was a good game, we either won or lost, and then what happens to the score after that? It goes to 0 so that we can start the new game, correct? Well, a game in business lasts 12 months, and the profit and loss is our score. And once we look at that score on that 13th set of financial statements, now we've got to make an entry to turn the sales, costs, and expenses, the earnings accounts, back to 0. Now, what's our balance in sales number 1? 200,000. Debit or credit? Credit. What do we need? What entry do we need to make to turn that to 0? A debit. So, entry G, next to sales number 1, in the debit column, write $200,000. Okay? Cost number 1. What's the balance in cost number 1 after this adjustment that we made? $154,000. Debit or credit? It's a debit entry, right? Debit balance. But we have to credit it to zero it out. Now go ahead and complete that entry for all the sales and costs, the 2 sales and costs, and each of the expenses. Okay, and then stop. That will not balance, but we will make it balance in just a moment. So go ahead and complete that entry. This entry is out of balance right now, and as always, the one rule we never break is every entry has to balance, right? And this is just like that. To balance this entry, we need to take the $12,000 that we have now eliminated out of sales, costs, and expense accounts and credit that to retained earnings. So the very last line in that entry will be a credit of $12,000 to retained earnings. Now, if you were to check this entry to see if it balanced, you would find that there are $300,000 in debits and there are $300,000 in credits. Okay? Now, if you were to take the time right now to post that entry, which you normally would, what would be the balance in sales account after posting that? 0. What would be the balance in cost of sales after posting that? 0. What about in each of the expenses? What would be the balance in retained earnings? It's going to be a credit for $12,000, right? And now you're going to start out with 0 balances. Start the new year with 0 balances in sales, costs, and expenses, and start accumulating sales, costs, and expenses for the next year. Do you follow that? At the end of year 2, what are we going to do? Same process. We're going to 0 each of those accounts out and transfer retained earnings. If year 2, the net profit is $10,000, what will be our balance in retained earnings after year 2? $22,000. And so that retained earnings is there to accumulate the profits from prior years. Do you follow that? Now, retained earnings only exists in what type of legal structure? Corporations, right? Both S and C corporations. So since it doesn't exist in a proprietorship, do we still go through this process, do you think? Yeah, we still have to, yeah. Which account are we going to transfer it to? Owner's equity, okay? What about in a partnership? What accounts are we going to transfer it to? We're going to split it. If we had $12,000 worth of profit in a partnership, and those partners are sharing profits 50-50, which they don't have to. It could be 30-70, it could be 20-80, whatever they tell you it is. but normally it's 50-50, then it's going to be split $6,000 to one partner's equity account, $6,000 to another's partner's equity account. Okay? Regardless of how much each partner had drawn out during that year. See, so what if one partner drew out all $12,000 and the other partner hadn't drawn out any? They're still each going to get their share of income regardless of draws, okay? Unless they tell you that's the way they want to split it. The one partner might, or the two partners might get together and say, why don't you take the profit 100% and I won't take any, okay? Okay? Yeah. So they can decide, now that's not going to happen. That's not going to happen, but they might decide to split it on a different basis. And they can tell you what that is, okay? Now, company software today, as I mentioned earlier, oftentimes does this automatically, or not at all. QuickBooks has some logic built into it, where in future years, it automatically moves any prior year sales cost or expense balance into retained earnings. So you actually don't have to do this entry in QuickBooks, and it will still show up as though it was. And they do that so that you can keep previous year detail in the computer and access it for reporting and so forth without having to close that account out to zero. But the logic is in there. And it's got some advantages and disadvantages. Some people like it, some people don't. But they're the only software that I'm familiar with that does that. All other software does it more on an accounting traditional basis, and oftentimes it's just a menu choice. You choose that item, and it automatically makes this entry that you've just completed into the books. You can actually print the entry out. It's there, okay? And it zeroes out each of those accounts to start you out with zero.